Hello, I'm Damien Yeomans, Head of UK Investment Distribution for Credo. With Credo's UCITS funds recently reaching the 5-year anniversary, I'm joined for a short chat today by Rupert Silver, Lead Fund Manager of Credo Dynamic. Rupert, welcome. Can you tell us about the aim of the fund and how it's performed?
Thank you, Damien, and hello, everybody. Credo Dynamic is a sterling-based multi-asset fund. It utilises a combination of equities, debt and alternative investments to deliver equity-style returns, but without the associated volatility. The slide in front of you shows our 5-year track record. In white, you'll see our peer group, the IA Flexible Sector, and in blue is the performance of the Credo Dynamic Fund. The peer group has delivered a return of 20.5%, and Dynamic has delivered a return of 36%. That's an additional excess return over the benchmark of a little over 3% per annum, and this puts us firmly and comfortably into the first quartile. Additionally, as a sterling-based fund, many of our investors benchmark us to the UK indices. So this graph here, again, we have Dynamic in the blue, and I've added the FTSE All Share in the black, which gave a 17% return over the same period. But really, I'm using this slide to highlight the periods of drawdown, which I've marked in red. And hopefully you can see when the market pulls back, as it has done on 3 occasions in this graph, Dynamic may also pull back, but not to the same extent, showing we've delivered on our objective of equity style returns, but without the associated volatility.
How is it invested currently, and how would you summarize your investment strategy?
Sure. So Dynamic is run as a core and a satellite fund. What that means is roughly 50% of the fund is invested for the long term. That may be in bonds, alternatives, or in equities, but we're taking a long 5 to 10 year view, and we don't like to tinker much with that. We let time and compounding do its thing. The other half of the fund is a satellite. This has got a more flexible approach. Here, if we really like the market, we'll use this part of the fund to take risk, to take beta, for special situations, perhaps to add equities. Conversely, if we don't like the market or the economic backdrop, we can use this part of the fund to dial down the risk and batten down the hatches. Our current exposure is asset allocation exposure is on the left. You'll see equities in blue at 44%, a very small holding of cash, fixed income is at 30%, leaving nearly 22% in alternatives. And on the right, we've got our currency allocation. Here, almost 60% of the fund is in sterling. That's on a look-through basis at the underlying assets rather than where they're listed. And then a few other currencies, predominantly global and US dollar.
Focusing on the different asset classes now, and let's start with equities. How do you access and how has the exposure to equities changed over the last 5 years?
Sure. So our equity investments tend to fall in one of 3 buckets. Direct equities. This tends to be UK companies because we do like to meet management. It's been a long-term source of alpha for the fund, and when the timing is right, we do utilise exposure to small cap and mid cap. Where we haven't got expertise or we can't access management, for example, overseas funds, US or Asia perhaps, we're going to look for an active fund manager. Someone whose methodology we can understand, who's got a solid track record, who we expect to outperform going forward. We do sometimes have a bias for investment trusts here. They tend to perform better in the long run because managers aren't distracted as much by the flows in and out of their fund. We also utilize ETFs. ETFs is a great way for us to get exposure to the beta of the market at a very low cost. Often it's market cap weighted, and sometimes we actually like to use smart beta or factor funds. The diagram on the right shows the equity portion in color of Credo Dynamic and how we'd split it up. You'll see on the outer ring, 18% is direct equities, 10% active funds, investment trust, a smaller amount of active funds, UCITS, and then 12.7% ETFs. The inner ring shows our exposure to overseas and UK. Overseas exposure, when combined altogether, comes to 27% of the fund and a little over 16% in the UK. In terms of the journey, we started as a relatively balanced fund. We struggled to find the right direction for a little time, and Brexit was always a concern. I guess the first big move came post the pandemic. It became apparent that tech was a good place to be as one of the main beneficiary of what was going on. And of course, there was stimulus after stimulus for the market. So we increased our equity and slanted that towards growth and tech stocks. At around about the middle of last year, we started becoming a little bit worried about the valuations of the backdrop. The markets were still good. Risk appetite was high, but it was getting a bit too high. The meme stocks were well documented for doing some crazy things, and at that point we started thinking we need to take a little bit of risk off the table. We started reducing equities and also tilted the portfolio more from growth to value. At around about the turn of the year, we actually got more worried about equities. Inflation was picking up, and the chairman of the Fed was quite clear that this was no longer going to be transient. That was the end of the last year, and we had to make some more changes there. Again, we tilted a little bit towards value, and we continued to sell down stocks, particularly from the UK, where we saw a heightened chance of recession, and particularly also from smaller and mid-cap companies, which tend to have a more volatile ride when the going is tough. We're now at 44% equities. That's the lowest we've been since the fund launched. The range to date so far has been up to 65% at a high of summer last year, and then down to 44% now.
Thanks for that. And moving on to fixed interest, could I ask the same question, please, Rupert?
Sure. So with regard to our fixed income, we tend to focus on BB and BBB bonds. Over the long term, this has simply been the best risk-reward place to be. The fund started its life with a little over 30% in fixed income. This is our exposure in front of you over the last 5 years. You'll see for most of the fund's life, it oscillated somewhere between 30 and 36%. Towards the end of last year, when we were worrying about equities, we also started worrying about bonds. Really, the compensation for the risk wasn't there, and we started selling off bonds. Not only were we letting bonds mature, but additionally, we're actively selling names that hadn't matured. And this took us to a low of about 19% of the fund. The story's changed somewhat this year, and particularly in the last 3 or 4 weeks. Yields have really ballooned, and we're now at a higher level than they were at the pandemic. And during the pandemic, of course, it really was a fantastic opportunity for anyone who bought corporate debt or equities. So we have been adding, and particularly with gusto, if you like, in the last few days. Having said that, we're still below our long-term average. We're at 30% now, and we've also been focusing on the very shorter dated names, particularly 1 and 2 years. This will reduce volatility in the portfolio and really give the fund managers a chance to think. It's great to know that in 3 or 6 or 12 months' time, you've got a bond redeeming, and then you can assess where you want to reallocate. Are we going into more bonds at perhaps different rates? Is it time for equities, or is it time to go to increase our alternatives? So the portfolio at the moment currently has an average redemption of 3.6 years. And gives a yield of 7.6. We think this is very attractive. We think we've bought some bargains in the last few weeks. And although it's slightly below where inflation is trading now, where inflation is at now, I should say, we think next year, if the market is right and inflation comes down a little bit, these yields were going to be looking very attractive, both in absolute and real terms, and are going to be hard to replace.
And moving on to alternative asset classes, you have a healthy exposure within the fund. How do you think about the role of alternatives, and how do you identify suitable options?
So just to define alternatives for us, We're referring to an asset that is less correlated to the traditional equity market, something that might provide a bit of income and will certainly provide a little bit of ballast during times of uncertainty. So towards the end of the last year, when we were reducing both fixed interest and equities, this was a really useful part of the portfolio to increase. It's currently 25%. All the investments that we hold must be listed. Primarily, they're investment trusts. To give some examples of what we own at the moment, these could be commodities, REITs, renewable energy assets, which is quite a large exposure at the moment, infrastructure, and a small amount of private equity.
It's been an eventful 5 years for investors. Could you tell us what you think was the most difficult time for the fund?
Well, Brexit was a pretty tough time for us, particularly as a sterling denominated fund. And then came the pandemic, the quickest, or certainly one of the quickest falls and then quickest rebounds in the history of stock markets. And of course, the current environment is anything but easy. It's quite confusing at times, particularly high inflation, probably the highest time since the 70s, the highest rate since the 70s, and of course, a war in Europe. But in reality, the market's always going to throw up these hurdles, and that volatility allows a tactical and a nimble manager to perhaps take advantage of certain situations. And I think this has probably actually helped us in creating that excess reward over our peer group.
What do you think differentiates Credo Dynamic from other multi-asset funds?
So there's probably four differentiating points I'd like to make. I think firstly is the fact that we do invest direct. This is in equities, but mainly in fixed income. We back our judgment in areas where we have expertise, and there's just no need for us to get an extra layer of fees within the fund. Secondly, I'd draw to alternatives. I think our exposure is much bigger than many people in our peer group, and it's been a good call, particularly over the last 12 months, where it's been a notable part of the portfolio. In addition to the actual amount, I think the assets are slightly different too. I think people, when they talk about alternatives, perhaps are thinking of certainly private equity, to which we have a small amount of exposure, but primarily to hedge funds where we have no exposure at the moment, and to cryptocurrency where we certainly have no exposure. So yes, I think that part of the fund is quite different. Thirdly, our use of small and mid-cap companies. It's not utilized, something that's not utilized too much in our sector and rarely used in a balanced fund. But over time, small companies lead to higher returns. So when the time is right, I think this is a useful tool in our armory and something we will continue to utilize. Last but not least is our agility and our flexibility. Of course, we draw on the whole Credo ecosystem for knowledge, advice, counsel, and research. But at the end of the day, there's two managers here. And we believe it's important and have the ability to act decisively when the time is right. And that's been important to us, particularly in this quite tumultuous last couple of years. And I think has helped us achieve the outperformance that we have to date.
And finally, could you suggest who you think the fund may be suitable for and provide us with a brief recap?
Sure. For a quick recap, Dynamic is a diversified portfolio that aims to produce equity style returns, but without the associated volatility. It has demonstrated that it offers more protection than equities in times of uncertainty, and it is an alternative to a more traditional 60-40 portfolio, which has come under pressure this year. It's a differentiated and nimble investment offering. We are building on a strong track record, and I haven't mentioned, but of course, worthwhile noting, both the fund managers are significantly invested in this fund. With regards to suitability, de facto risk rate us 5 out of 10. It does have some equity exposure, even though it's lower volatility. So really, we would think it's suitable for anyone who can take a modicum of equity exposure.
Thanks, Rupert. That's a perfect place to finish. Congratulations once again on the 5-year anniversary and also on the strong performance since launch. To our viewers, thanks for watching. Please remember that Credo Dynamic is available on a wide variety of investment platforms, both in the UK and in South Africa. If you'd like to get in touch or have any questions, please do so using the contact details shown. Thank you and goodbye.